Alright guys, we're going to get this presentation going here for you guys. For those of you who don't know me, my name is David Zarling. I am the head of investment strategy and research here at Client First Tax and Wealth Advisors. I use the Adaptiv Investment Management System to navigate markets, and as always, these presentations that we give, which is part of our Lunch and Learn education series that we put on every month, every quarter, is something I present as our market insights. This month or this quarter, we're reviewing a pretty important market development that's taking place that hasn't really been something of a concern for 35 years. Really a changing dynamic, and we'll cover that in this video. But as always, this presentation is for informational and educational purposes. Don't be using it for a basis for investment decisions. Our full legal restrictions are located on our website. You can find the link there. You can see it in this slide here. But why don't we jump in and get started? As I said, this is part of our Lunch and Learn series. This is something we do for our clients and those who want to get to know us. We get together typically the third Wednesday of the month. We had a really great turnout this last month. So thank you to all those who came out and enjoyed some good food with us and enjoyed hopefully some good education for you. That's what we're going to cover here. And I'm recording this for those people who didn't get a chance. We do have noon and evening sessions available for our market insights. And if you couldn't make that, that's fine, no problem. I understand how life is busy, but this is for you guys, or maybe it's for someone who just wants to review and learn a little bit more about us. And you can sit down, have a cup of coffee, maybe breakfast, and listen to this video. It should be about an hour long. But why don't we jump in? And the reason why I've got these pictures on here actually has to do with, this is Ocean Beach, California. And I was on a date with my lovely wife at a place where they make amazing fish tacos. And this is kind of the view. I'm not, obviously these pictures aren't the best pictures I've ever taken, and they don't reflect, in here there were some surfers and it was just a beautiful evening, eating some really good food. This was the view from on the left hand side here, this was the view from where we were sitting and having a great time. Place was packed, and maybe you know what I'm talking about, like just a good meal, good time with my spouse. Packed place, and this young man walks in and sits down next to us. Nobody with him, just by himself, probably late 30s. So at one point I just felt like maybe I should strike up a conversation, so we started talking a little bit. And he, because, I was impressed by the weather, of course. Being a Wisconsinite, we get our seasons, and out there it's typically around 70 degrees all the time. Not necessarily the whole time, but, he just mentioned that he'd been out there for about 10 years. He'd gone through 3 best friends, just from the standpoint of people move in, then they move out, very transient area. And he said the thing he missed the most were the seasons. He's a Buffalo, New York native, and what he missed was the change in seasons. And that's why, I want to jump into that a little bit, because we're in a new season ourselves, right? And everything has seasons. It can be in our life. We have different seasons in our life. Obviously, the weather outside, different climate changes, different seasons, right? And they can also take place in markets, and we're going to jump into that a little bit today. And of course, we're heading into fall here, and so that gives you kind of an idea of that. And that this time of year, we get all our different seasons, but obviously this time of year's, the temperature's changing. The leaves are changing. It's a season of change. And when I think of hunting, for me, one of the things that is important to me in my life during this period of time is going hunting. I really enjoy it. I love being outdoors. It's a chance to be by myself. It's a chance to be with some of my friends. It's a chance to enjoy God's creation. It's an amazing thing to be out there and experience it. It's not something you can get behind a computer screen or at home, or sitting inside somewhere, or watching Netflix or whatever. Being outside is just something I find enjoyable, and hunting is one of those big things during the fall. And really what that leads me to is, here are my little hooligans, my 4 kids. Emily does a good job keeping them cataloged. These are their separation in years. This was last year. before school. This was this year before school, and right, that's part of fall too. We started school recently, and obviously there's a nice trend here among these young guys. And Eli this past weekend took hunter safety education, took some courses online, then went out to do his what's called an internet field day. So they go the whole day. It's actually about 6 hours, and they spend some really good time with some instructors, learning how to be safe in the woods, learning how to handle a weapon. And it was also a great chance for me to brush up on some of those things I learned. And of course, being the nerd that I am, I had to look into and review, hey, what's the history of hunter safety in Wisconsin, right? Here's a chart showing incidents of accidents in Wisconsin dating back to when hunter safety program was initiated back in the late 60s. And you can see some of the improvements they've made over time, including, having to wear blaze orange. 1985, mandatory hunter education begins. There's a nice trend here too, a decrease in amount of accidents that are happening, with a firearm per 100,000 hunters. And one of the things that stuck out during, the education for Eli is this idea of tab K, TABK. And I'm not a big acronym guy. I think there can be a lot of confusion with acronyms, but they can be useful for learning. And what's noticeable is this is the history of gun deer accidents. This is the year 1984 on the left-hand side. Tab K, well, obviously mandatory hunter education begins back then. We can see the decrease, and tab K is introduced in the early 90s, but this dramatic decrease in accidents since these things were implemented is pretty obviously significant. And so what is tab K? Tab K is something that was used in his education, and it stands for, T is for treat every firearm as if it were loaded. A is always point the muzzle in a safe direction. Obviously great advice. Be certain of your target and what's beyond, right? If we're looking to harvest an animal, we need to know what's past or beyond that animal, right? Shotgun can shoot pretty far. A rifle can shoot up to 3 miles. So we better know what is beyond our target and understand that. K is keep your finger out of the trigger until ready to shoot. And these simple rules, okay, this sequence of rules has really helped decrease accidents in Wisconsin woods, minus 83% in incidents since the early 90s. So going hunting in Wisconsin, I think sometimes there's a poor stigma about hunters. It's gotten a lot better since we've been adhering to these rules, and it makes me really excited, right? Hunter safety is important. It makes me excited for Eli, both for his safety and for him being safe around others. And don't worry, I'm going to tie this into what we're talking about today. And it may seem a little bit random, but I think it's important to understand what proper risk management looks like, and in this sense, when it involves hunting or a weapon. Our agenda for today that we're going to cover our topics du jour, midterms and trade wars. Midterms are obviously coming up, and trade wars continue to be a topic covered in the news, and we'll go through that. We'll also review how the Adaptiv System identifies strength and weakness, right? I'm rounding, but there's about 30,000 different things available to all of us to invest in. How do we go about it at Client First? How do we use the Adaptiv System to identify areas of strength, places where we want to be, and areas of weakness, obviously places we don't want to be involved with? Then we're going to talk about this major market development that is going to have an impact on portfolios going forward. It's something that we haven't necessarily seen in 35 years since I was a young child. And there's also going to be some bonus material in here after we do what's normally our question and answer. What I'll ask you to do, if you're a viewer of this, is if you do have a question, you obviously can email me or call in. I do like to make myself available to you guys. I like talking about this stuff. So feel free, if you got questions about things in this video or the Adaptiv System, you can email us at myteam@clientfirsttaxandwealth.com or call us at 262-335-1700. And then there's just some wrap up and some final thoughts that I want you guys to leave with at the end of this video. But jumping right in, midterm elections, obviously this is a big topic that is in the news right now, and rightfully so. November 6th is right around the corner. I think it's about less than 3 weeks away, and there's 33 seats up for grabs in the Senate. There's obviously 435 seats in the House of Representatives. 14 state governorships are up for having elections, and we're going to focus on the Senate and the House of Representatives. We're not going to spend too much time on state governorships, but jumping into the Senate, what's taking place there, this visual will give you a good idea of what's going on currently. So this is my opportunity to tie in some investment education here. So everybody, or I shouldn't say everybody, many people are familiar with the S&P 500. It is a market cap index. What that basically means is it's very similar to the House of Representatives, okay? So the House of Representatives is based on populations within each state, okay? So a state like California is going to have more representatives in it, or more representatives for it than Wisconsin. Whereas the Senate is more what we would call an equal weight S&P 500 index. And there's two of them. There's two different indexes, believe it or not. The one that's on TV all the time is the S&P 500 cap weighted, and that's like the House of Representatives. Right now here we're talking about the Senate, right? We get 2 senators per state. Right now there's 23 plus 2 independent. There's 23 Democratic seats open and up for re-election. 9 Republican seats up for re-election. Currently, the split is 51 Republicans to 49 Democrats. Obviously, you need, if the Republicans gained 8 seats, they'd have a filibuster-proof majority. The other thing I like pointing out at this juncture, and again, I'm not a political pundit, so really you're not going to get anything out of me on what I think is going to happen in the election. I have no idea. We'll find out the evening of November 6th. But what I like pointing out is there's a word that's been repeated over and over and over in the media, and it's that fun word impeachment. And again, not a political statement, but we've heard it regarding our current president. We've heard it regarding Supreme Court Justice Kavanaugh. It's really important to understand that you need a 2/3 majority in order to impeach someone. Okay, first it starts out in the House of Representatives, then it's passed along to the Senate, who's got to investigate, and then they vote. Okay, and you need 67 votes in order to impeach someone. And just by looking at this data here, right, we're big on data, the idea that there's going to be an impeachment vote that passes to us seems like a very low probability, even though it seems to be something that's harped on in the media over and over and over. House of Representatives, obviously you need 218 for control. The current situation is there's 238 Republicans and 193 Democrats. According to this data, there's 21 toss-up, and then there's some leaning each way. Like I said, I have no idea what's going to happen on November 6th, whether it's a red wave, a blue wave, a purple wave, I don't care. Everybody should go and vote, and you should vote based on your own personal framework, the values and the things that you hold important in your life. You go ahead and do those things. You're not going to get a recommendation out of me. And this other data table over here is just highlighting seats that are available that might be vulnerable, just because maybe you've got some Republicans that are in typically Democratic districts, or maybe you have some Democrats in some typically Republican districts, and those are going to be interesting to see how they fall out. Again, I don't know how it's all going to play out on November 6th. What I do know is that please be careful as you consume media as we get closer to that day, because we've been down this road before, and they may not have our best interest in mind. There's going to be a lot of sensationalism. For example, the last major election was November 2016, where we had a presidential election involved, and we know that leading to that, many, almost all media outlets were predicting a very large probability chances of winning for Hillary. You can go on our Facebook page and check it out, but at the time we actually thought there was a strong possibility that Donald could get elected. Again, it wasn't based on political stance, it was based on market data. And you can check that out on our Facebook page if you want. But the point being that we need to understand what we're consuming on TV, online. And the reason why I like bringing this up is we live in a world of recency bias. Okay, so recency bias means those things that have happened most recently in our life impact us the most. Okay, rarely do we actually go back and look at, was the media accurate? Was the media correct in what they were talking about at that time? And we like to do that here, not to bash on them because we know they have a job to do too, but it is important to highlight, do they have our best interest in mind, and are they providing accurate information? You know, in this case, everyone predicting one side would win or one person would win, and it actually ends up being someone else. Well, we need to hold people accountable when they do that. You know, for example, the other thing that took place was when President Trump was elected, so much media coverage on that there was going to be a market crash. Well, how did that happen? You know, I mean, how did that work out for people? If you listen to what was told to you on TV, and many people were saying, market's not going to recover, there's going to be a crash, you need to be carrying large portions of cash, but yet presidential election happens, and even from these February and April lows and earlier this year, it's a 25% gain in the market, in the S&P 500. And so really we have to keep in mind that recency bias really affects us, and we seem to forget things that were reflected through the media, you know, weeks to months ago, and keep that in mind. All right. Now, as far as what's going to happen in the market related to midterms, midterm years are typically very volatile periods. Most years, what this chart shows is that there are what's called a drawdown. So from a high to a low in a market year, some of these, and this goes back to 1962, it can be anywhere from -7% to -38%. So, you know, from a high to a low, that's how much the market will drop during a midterm year. But you'll also see a recovery after the correction. And some of the recoveries after those corrections are pretty significant. And so we can expect some of those things, right? We've seen a volatile 2018, haven't we already? You know, whether it's the late January, early February sell-off, what we've seen as recent as last week, and we're going to actually touch base on last week at the end of this presentation. But midterm years are historically volatile. You know, when we look at how they typically have worked out in the past, you know, this year, the way it's looked is that originally through the first 3 quarters, now this has changed now, the S&P 500 being up 8.7%. As of today, it's actually up around 3% because of the correction that took place last week. However, typically what we see is actually a correction into this point and then a recovery after, right? So we get the market is down going into the election, and then fourth quarter, everything looks, you know, recovers. It's really interesting to see that we started out well and we seem to be, you know, correcting right now as we speak. So we'll see where we end up at the end of the year. We'll see how things shake out. But I can tell you that there will be volatility. I can tell you that the media will try to tie market performance to who's ever elected into the Senate or whoever has majority in the House of Representatives. Don't fall for it. Because the market's going to do what the market's going to do, okay? You know that chart before that I showed that, you know, the market going up 25%? There's also a side that said, oh, that did that because of Trump. Maybe. We'll never know, but I can tell you that it could have done the same thing if Hillary were elected, and maybe it wouldn't just be it wouldn't be in the same areas of the market, right? The market's not just one thing, one solid thing. It's a market of stocks. So market could have done the exact same thing. And quite frankly, when we look at the data, no political party has a monopoly on market returns. So you don't have to sit there and go, oh my goodness, this party got elected, what's going to happen now? The data doesn't show that. And so we're going to stick with the data. The next topic covered a lot in the media is tariffs and trade wars. If you want, I'm not going to really dig in at this point on what tariffs are and get real granular with it. If you want, check out other YouTube video from April. Okay, that's the first quarter market insights that I gave. I dug deep into tariffs and really what it meant for peace negotiations with North Korea. At that time, okay, in April, we hadn't even met with the North Koreans yet. So maybe it was outlandish in that presentation, but what we were seeing based on what was tariff related during that time really had to do with North Korea. And since then, we've moved closer towards peace with North Korea. They're talking about denuclearization. So we'll still cover tariffs here and trade wars, but if you want further detail, check out the April YouTube video. You can go in there, and I spend quite a bit of time on it. But it is a topic that the media is covering, and they seem to be attaching it to daily moves in the stock market. Here the stock market's down because of the trade war, and then here the stock market may be getting it wrong by rallying in the face of new tariffs. Now, be very careful here. This type of headline is a pet peeve of mine, because I will tell you that the stock market is going to do what it's going to do, and if you continually fight the stock market with your own personal pride, it's not a good combination. And what I mean by that is, imagine your next door neighbor sells their house, right? And they sell it for some amount that you sit there and go, that can't possibly be correct. They're wrong. That's crazy. Well, no, if a seller and a buyer agree on a price, that's the price. It's fact, whether you like it or not. Whether we like the price of the stock market or not, price is price. It's an agreement between a buyer and a seller, and it is what it is. We can make up all sorts of reasons on why, but in the end, it doesn't matter. The market's going to do what it's going to do based on economic law, supply and demand. So whether tariffs affect price or not, it's just going to be a fun news item for them. What I like pointing out is that when we look at market movements, it was in February and April that the media decided to focus on how all these different tariffs would hurt us, but completely ignoring the fact that during this run up here, we were pulling out a Trans-Pacific Partnership, renegotiating NAFTA. There were tariffs already ongoing, new tariffs between the US and China. And so the media just likes to latch onto things and try to figure out what's going on, right? Because they have a job to do. Like, if they're 24-hour news stations, the market drops, consumers want to find answers, and so they turn on the TV, and they better have some type of answer on what it is. It can be both a good and a bad thing. So we need to understand that media is grasping for straws too, and may not have our best interest in mind, okay? So understand that when you're consuming it. Understand that when you're watching TV, going online, that some of what's being given to you is really based on the need to sell advertising, the need to sell cars, the need to sell razor blades, what you name it, whatever the commercials are for. That's what a TV station does. That's what a website does. This isn't something they're doing out of the goodness of their heart. It's something they're doing in order to sell advertising. And so keep that in mind when you're consuming information, and understand that TV stations are not fiduciaries like registered investment advisors are, where we have to operate in your best interest. TV stations don't have to operate in your best interest. They operate in their own best interest. So keep that in mind. In addition to news, so outside noise, we also have our inside noise, right? Our own personal biases, where we go and we find the things that confirm the beliefs we already have. Our minds are crazy things, right? They're beautiful. God created them. We've got, intellect and logic and creativity and all these things processing one. It's more our brains are more powerful than any artificial intelligence, any supercomputer, and quite frankly, we were the first artificial intelligence ever created. And sometimes we can be our own worst enemy with the internal conversations we have with ourselves. Loss aversion is a really important bias to highlight, or an aversion that we have, where if you've got $100 and it grows to $150 and then back to $130, we actually feel that that's worse than the original 100 we started out with. So for many people, a 3% loss feels twice as painful as a 3% gain. So think about that in a market. Since the 1900s, the Dow Jones obviously is up during that period of time, right? But if you were just to focus on day-to-day activity, up and down days, about 53% of the days are up, about 47% of the days are down. So if your pain threshold is twice as much on down days, you might think that the Dow Jones was down from 1900 through today, and that's not even true. Another example of that would be, here is the percentage daily change of the S&P 500 last year, 2017. Look at this. This would be a tremendous roller coaster for someone who watches on a daily basis, all right, doesn't follow trends, but just watches daily red and green, and has to deal with loss aversion. You know, if a person with loss aversion might even think that that was a losing year, but it wasn't. 2017 was a great year. The S&P was up almost 20%. So we need to be cognizant of the fact that we have outside noise, inside noise. And so what do? We focus on the signal by using our adaptive system. We use raw data, we use price itself. That way we can avoid the noise. And so let's dig into that a little bit. Let's talk about market reality, right? Some of the market realities we have to deal with. Here's the S&P 500 going back to the late 90s. You know, we've got some context on here. And if you're not familiar with the S&P 500, just a quick analogy if I can. It's very much like a grocery cart that has all these different things in it. You know, it could be food, it could be, you know, just different things you need in your life. And every single thing in that shopping cart has its own price. And when you go to checkout, though, they don't make you pay for those items separately or individually. There's just one price. That's the S&P 500. 500 of the U.S.'s largest stocks, and it's a checkout price, all represented in one basket. And we can see economic law and supply happening, right? More buyers and sellers driving price up, more selling and buying driving prices down. And then for context, you know, an account exposed to this, right? A $500,000 account in 2000, by the year 2003, would have been cut almost in half, and then back to even by 2008, if you were able to hold through all of this. Or cut in half or over half again in 08-09 during the great financial crisis, and then back to even in 2013. So for 13 years, right, across this period of time, the market went nowhere, right? It went nowhere. My line's not too straight there, but you get my point. That kind of gives you the idea of, maybe I can draw something that's a little straighter. How about that? You know, if it went nowhere but heartburn. This whole period of time is 13 years, but nothing but heartburn. Okay, and then we also have to deal with the flaw of averages. Okay, so the flaw of averages basically is, you'll read or you'll see academically or in the news that, oh, you can expect a 7.5% return in the market. Well, in actuality, a 7.5% return. So if at the end of this year, 2018, the S&P 500 has a 7.5% return, it is the least likely scenario. That happens about 5 to 10% of the time. This average is really dictated by extremes, right? Over here on this side, about 20% of the time, 1 in 5 years, there's going to be a 10% loss or greater. On this side, about 1 in 4 years or 25% of the time, there's a 20% gain or greater. So it's these extremes that dictate the average. It's very similar to, you know, in Wisconsin, the average temperature is about 48 degrees. Well, we know that's dictated by extremes. On 4th of July, we can't go outside and expect it to be 48 degrees. Same thing, January 1st, it's very unlikely that we're going to walk outside in Wisconsin and find it to be 48 degrees. It's at extremes. Same thing in the market, right? And we have to deal with these extremes through all these moves. And these moves right here, minus 46, minus 57, very detrimental to a retirement plan. And we do true holistic planning at Client First. And the reason why we do the adaptive system is it ties in very well with how do we handle market environments like this, okay? Because I always tell people, you know, if we're blessed, if we're lucky, you know, we can pick where we live when we retire. The one thing we can't do is pick the market we get when we retire. Is it going to be another 13-year period like this here? Or is it going to be like, you know, 1982 to 2000, a nice bull market where everything is relatively easy compared to a period like this? We don't know. And the fact of the matter is, when we talk about risk management, those drawdowns, right, those moves down in price, minus 46%, let's call that minus 50%, just to get back to even, you have to get 100% return. So as these bigger drawdowns take place, just to get back to even, you need to have greater return just to get back to even. So risk management is a must. Okay, and for us, what we use the Adaptiv Investment Management System. It is unique to us. It is unique to Client First. No one else is out there using this. And this is where I get to try to tie this back into an acronym. Things that we need to keep in mind that are important for an investment system. And for us, AIMS stands for always identify risk versus reward, right? If we go into a crowded room, we should probably look where the exits are, right? If we go to a concert some band that we really love and we go in and it's packed and it's awesome, we also have to be looking where the exits are because bad things can happen in crowded rooms. Same thing at Client First using the Adaptiv System. When we enter a trade, when we enter a new position, we already know where our exit is, where the position has moved against us, and we need to not be involved with that thing. We want to invest with the direction of the trend, right? Is it easier to swim with the stream or up against the stream, right? If we're in a boat, is it easier to be paddling down the river or up the river against the current? We want to invest with the direction of the trend, and we'll cover how we identify trend. Then we want to manage risk using weight of evidence and position sizing, right? We know that when we take on a new position, it better not be so big that if it's wrong, right? If it's something that we need to, because we identified our exit, our risk, right? That if we have to exit it, that it's going to hurt the portfolio at large in a big, big way. And then we want to stay disciplined to the system and the hard data itself, price, okay? Coincidentally, AIMS also stands for Adaptiv Investment Management System, okay? And we're going to have 3 outcomes when we use the Adaptiv System: big wins, small losses. Notice there's no number 4, right? No big losses, right? Because we just talked about that. When you have big losses, it takes a lot to get back to even, all right? And the other thing that this points I want to highlight with this is many people, investors, get this wrong where they think they need to bat 1,000 in order to be successful in investing. Not true. It's more like being a hitter in baseball, okay? There are times where, yes, you will strike out, but that risk of striking out is so little that it's worth taking, okay? So small losses. But what we're not going to have are these spots where we're taking on positions and having them drop 20, 30, 40, 50% and crush our portfolio. Okay, so by using our system, and we're going to go through here in a second, it'll give you an idea how we avoid number 4, big losses. So let's jump into it. The Adaptiv System is based on 3 main pillars, the most important being price itself, supply and demand, right? More supply than demand, price drops. More demand than supply, price rises. And we can track this mathematically on charts. And we can use that information to identify trends, which sounds very cliche, but we'll jump into it so you can see what we mean by identify trends, right? Because we want to be with the current. We don't want to be swimming upstream. We want to swim with the trend. We want to invest with the trend. Then we use that information to identify relative strength. Where is the strength in the market, right? We're not just up there throwing darts, right? I just remember this old article where they're talking about, a monkey throwing darts could pick in true investments. Well, guess what? That's not a strategy. That's not a system. And we'll show you how we do it. That really highlights how we can avoid bad pieces of the market and be involved with good pieces of the market. But first, let's jump into trend. Let's jump into price. Here's the S&P 500 again. We can see supply and demand happening. It goes back to the late 90s. I could have gone back much further, but I don't want to bore you. And again, what I'm about to go through, we can use on any asset class. We can use it on bonds. We can use it on commodities. We can do it on currencies. We don't necessarily trade currencies, but it's part of that weight of evidence approach. But let's talk about trend. So what we do is this blue line that's running through here is the prior 40 weeks of information averaged. So blue line, prior 40 weeks averaged. Okay, we can track that. And what it helps us do is eliminate noise, right? If you're watching this YouTube video and you got your nose up against the screen, you can't see what I'm showing you. You need to step back and be able to see. That's what the blue line does. It helps us step back. Is this, where is the current? Okay, are we in an uptrend? Okay, are we in a downtrend? That's important. We want to invest with the trend, right? And if the trend is down, maybe we shouldn't be investing with that. Okay, so those are things we want to keep in mind. It helps us identify trend, very important part of our process. Then what we do is we combine that with an orange line. So the blue line is 40 weeks of information, right? The orange line is 10 weeks of information. And what we know is based on the data, okay, going back all the way in time, when orange crosses below blue, okay, in an environment like this where orange crosses below blue, like that, we know that bad things tend to happen in that scenario. It's not a guarantee of bad things, okay? So let me clarify, not a guarantee, but that's when bad things tend to happen. It's very much like saying, hey, it's below 32 degrees, there's precipitation, that means snow, maybe we shouldn't drive. Okay, we don't know how bad the snowstorm's gonna be, but maybe we should park the car and respect the risk that's taking place right now. And so that's what we use it for. When orange crosses below blue, we're no longer involved with that thing, okay? So we can avoid downtrends like this, but yet be involved with uptrends like this one, okay? It's very important, right? Because it helps us avoid these major drawdowns, these 50, 60% moves down in time. And it doesn't guarantee that every period like that it's going to be down. There are times where it's a shorter duration, but we take an abundance of caution and we don't try to pick bottoms. But when buyers are in abundance and they can push orange back above blue, we'll participate again. But we have no business being involved with episodes in the market like this where we need to protect assets. And quite frankly, when I say protect, each market environment is different, right? Each snowstorm is different. In 2008, 2009, if you had done orange and blue lines on commodities and bonds, with the exception for a few months in bonds, orange was below blue. There was nowhere to hide. And we will literally hold client accounts in FDIC insured cash at TD Ameritrade, which is where we do our fulfillment. So that gives you an idea that we don't have, cash is a position too. We don't have to be involved with that things that are going down in price. And so, but you know, other market environments like this, 2001 through 2003, if you looked at bonds, orange is above blue, we can be owning bonds. But the general concept here that I want to drive home is that if your account's not going down in value and we're moving sideways, we're basically moving this whole chart up. You know, we're not dealing with these 50% moves down. We're taking distributions out of there. You know, they talk about dollar cost averaging or buy everything and hold it forever. So if you buy everything and you hold it forever, you're dealing with nothing but heartburn in periods like this. Plus, you're taking distributions out during these periods of time, which is very detrimental to a retirement plan. Imagine having your nest egg cut in half and then trying to live off of that income. By using our system, we can avoid those big moves down. There's still going to be volatility, but it looks a little bit more like this, where we're avoiding those big moves down. And the flat numbers are, and I'm rounding, I didn't do this out to the penny, so rather than being even by 2013 over that period of time, an account value during that period of time could be about triple. And so it's not a, you know, a straight line. You know, we know everybody would just love a straight line, but at the same time, we're not dealing with market reality, you know, these 50% moves down in time. So it's a little bit smoother. It's a smoother process. It's meant to fit with our true holistic planning. And it's what makes Adaptiv unique, right? The fact that we can use cash or we can protect accounts is much different than what the industry says, right? The industry says buy and hope, right? You're going to buy and just hold on to it no matter what happens. And you're going to diversify. You're going to own everything, even the moldy pieces, okay? So that's trend. Here's relative strength. When I was doing the presentation live, you know, I asked the question, can any of you tell me which of these runners is going to win this marathon? And obviously no one could because it's a snapshot in time, right? So if we just look at price on a daily basis, that's what we're doing. There's no way to gauge who is probably or what are the likelihood of certain runners going to win the race if we're just looking at snapshots in time. But let's talk about how we can identify the winning runner using relative strength. So for that, I'm going to use this Coke and Pepsi challenge, which is me trying to be clever. I don't know if you remember those commercials back in the day where, you know, they had a taste test and I don't know, I always tell people either one with a little bit of whiskey in it is fine by me. But what we're going to do is we're just going to go through the process of should we own Coke stock or should we own Pepsi stock? And that's going to give you a really good idea of how we think about this big picture, okay? So here is a price chart of Coke stock from 2016 and 2017. Nothing significant about that period of time. It's just when I put this together, you can see supply and demand happening in Coke stock. This is Pepsi stock alongside, you know, comparing it side by side. You know, here's Coke stock, here's Pepsi stock. Maybe there's a little bit of difference in this period here. But what we do to identify relative strength is we take the price of Coke stock and divide it by the price of Pepsi stock, and that gives us a ratio. And the ratio also travels on charts, and it looks like this. And we know it's a mathematical certainty that when the ratio is falling, that means Pepsi stock is doing better than Coke stock. And when the ratio is rising, Coke stock is doing better than Pepsi stock. Okay, so that's really important. And where that gets powerful is we can combine that with our orange and blue lines, right? And we can have our rules simply be in this relationship. When orange is above blue, we're going to own Coke stock. When orange is below blue, we're going to own Pepsi stock. And then we can switch back to Coke stock. We can identify when strength changes between these two things. And to prove that point, from this area here, when we switch to Pepsi and own it through here, Coke's up about 4% during that time. Not bad, but we like 10% better. And then by switching to Coke stock here, we can enjoy 1.5% while Pepsi's down 4.5%. And so through that whole process over a year, that's actually a net 10% difference just by identifying where that strength is, where the relative strength is in that relationship. And so we can do this across everything. So if you think of markets like a loaf of bread, a lot of 401k plans will divide it up and they'll slice it this way, and you have some large cap funds and some mid cap funds and some small cap funds in your 401k, and there's nothing wrong with that. But we can do that Coke Pepsi analysis between large caps and mid caps and small caps versus the loaf overall. We can also slice the bread traditionally, right? And we can have different sectors that we look at. So there's a slice of bread that's technology, and it has Apple and Google and Netflix and companies like that, or Amazon, or utilities, and it's got Wisconsin Energy in it, or financials, and we've got JP Morgan and Goldman Sachs, or energy that has Exxon and Chevron in it, or industrials, and it's got Boeing and Caterpillar in it. And we can compare, we could take industrials and we could do the Coke Pepsi analysis for each one of these slices, and we could do it versus the loaf overall. And what that helps us do is identify which slices are strong, but also which slices are moldy and shouldn't be owned. As an example, doing that Coke Pepsi analysis, it helped our clients avoid energy stocks or energy positions in 2014 through early 2016. During that time, energy was down 70%, right? No big losses. So that's part of the process, is identifying the moldy pieces of bread. Not only that, we can do that Coke Pepsi analysis, and there's loaves all over the world, right? I know we're talking about the S&P 500 in the United States, but the world is a flowchart for capital, right? There's another, I don't have Japan over here, but there's a Nikkei 225 for Japan. There's a stock market in Russia. There's a South African stock market, there's Latin American stocks, there's Canadian stocks. We can compare each of these things against each other, doing that Coke Pepsi analysis, and identify where the strength is. So it helps us identify, should we own any international stocks or shouldn't we? That's really important. There are times where we want to own those, and there's definitely times we don't want to. So that should give you a good idea. And we can also do this Coke Pepsi analysis. We can do that relative strength analysis between other asset classes. So we can do bonds versus stocks. Should we own more stocks than bonds? Should we own more bonds than stocks? So that leads me to the most important development in the past that's happened in 35 years. And I know I've got this picture on here. It makes it seem super ominous. It's just a dramatic change that could cause a storm. We don't know. But during my live presentation, I asked, what is this chart? Do you guys know what this chart is? And not many people could, but if you notice, it goes back to the early 40s. All right, it's through current day. Right here towards the peak of the chart is 1982. All right, 1982, I was just a young kid, obviously behaving my mom very well. But this is back, I'll give you a clue. This is back when mortgages were about 16, 17%. All right, this is the yield on 30-year treasuries. All right. All we've known for 35 years are downward rates, okay? Downward rates for 35 years. Before that, we knew a rising rate environment. But for us, we've known nothing but downward rates. That's changed, okay? When I sent out the letter to people we invited, all of you receiving this video to come to the presentation, the big change that was taking place is this breakout in yields, in rates, right? And when rates, we know how this works. If bonds are going up in price, that means yields are going down. Vice versa, if yields are going up, bonds are going down in price. And we know that's a big deal, right? So that if rates are breaking out here, that means bonds are going down. And what we like highlighting is that that's kind of a significant event. For example, here's a Coke Pepsi analysis of 30-year treasuries or bonds, a type of bond versus the dollar itself, right? If you can't outperform the dollar, why in the world would you own that thing? And here's 30-year treasuries versus the dollar, orange below blue, breaking down, underperforming the dollar itself. And what do we know about bonds? For a long time, investment advisors, not us here, but the industry as a whole is saying, what should you own as you get older and are in retirement? More and more bonds, right? They tell people to own a 60-40 portfolio, 60% stocks, 40% bonds. Well, guess what? If rates are rising, if we're new in a rising rate regime, that means bond prices are dropping, right? And that's not so good. If 40% of your portfolio is dropping, not so good. And then if stocks decide to drop as well, 100% of your portfolio is dropping. And we can see what they've been, this is material I pulled off the internet where target date retirement funds, very popular in retirement accounts. This year 0 is your retirement year. They're telling you to own more and more bonds as you get older. So go ahead and own more and more things that are going down in price. We think that's a bad idea. And so this is an amazing development. Will it be straight up in rates from here? No, but the weight of evidence suggests that we are now entering a 35-year cycle of rising rates. Okay, and that's different. That can be good down the road for savings, right? CD rates that are increasing, that's a good thing. But if you're holding bonds, right, those bonds can be dropping in price in your portfolio as rates are rising. So there's a risk to retirees in that. And that's why we use the Adaptiv System, because we can identify if we're going to own bonds, right, because we're going to compare stocks versus bonds. So maybe we should be owning stocks, which the majority of our clients are now. And that'll lead me to another thing coming up here in a couple slides. But the next 35 years, likely to see higher rates. Now, that doesn't mean it's the end of the stock market run either, because we're market historians. Here's the 40s, late 40s into the early 60s. These rates are rising here. That was also one of the best bull markets in stocks that we've seen. So don't let the news throw you for a loop, because they will talk about rising rates being a death knell or some fancy word for stocks. That's not necessarily the case. We can see rates breaking out and rising and stocks performing just fine. Now, this is the part of the presentation where I ask for questions. I encourage you to email me if you do have questions at my team at clientfirsttaxandwealth.com. Go ahead and do that. If you're interested in hearing more about the Adaptiv System, we can do that too. We can schedule a time for you to come in and go dig into it in more depth, how it applies to you. Maybe you want a second opinion on your own personal portfolio that you don't have with us. We can do that too. What I want to end with and leave you with is a major development that took place over this last week that I think is very important to highlight. And this is the S&P 500 here. And what we see is orange above blue, which is good. That's one of our signals that we want to be involved with the market. We have raised levels of cash, full disclosure, for our clients. That may not be applicable to you, but for our clients, it is. We did this recently back in here. And what we saw, if I can use this marathon picture or analogy again, is if you can envision at home while you're watching this an aerial view of a marathon race unfolding, right? It's the beginning of the race where all the racers are strong. Everybody's together in a pack. It's towards the end of the race when we only see a few runners in the lead. And what we started to notice using the Adaptiv System in August and September is that all of a sudden we were seeing late in the race type characteristics, meaning only a few stocks holding up the S&P 500 overall, while small caps and other things are rolling over and making new lows. So not participating in the race. And this is a much different environment right now than what we saw back in January. And if you think about the psychology of this, right? All these people, there's people that bought in this level here, right? Anybody who bought up in here, what are they going to do as soon as price gets back up? Okay, just think about yourself. Oh my goodness, I lost all this money. If I'm back to even, I'm selling. So right now we have all this overhead supply. This is a concern for us. It's why we've raised cash levels for our clients. Now, if we get back above these January highs, okay, then free sailing, we'll be involved again, but we think caution, right, is the way to go. When I use that weather analogy, when orange is below blue, it's like winter. When orange is above blue, it's like summer. I will say that this type of environment right here is like fall. We can get some nasty weather in here, but we are monitoring with the Adaptiv System, and it's just something that developed this past week that I want to make all of you guys aware of. And if you have questions about that, obviously reach out to me. And then just leaving you with the fact that our AIM system, the Adaptiv Investment Management System, right, we always want to be investing and identifying risk and reward, investing with the trend, managing risk using weight of evidence, and we want to stay disciplined to the data, blocking out the noise, both externally and internally. The reason why we use this is we use a true holistic approach around here. It's why we've got tax preparation and planning and insurance, Social Security planning. It's why we do these educational videos. Obviously you're watching this and we're not charging you for it, but we think it's important to get this information out there so you can make decisions with quality information. It's why we use the Adaptiv System for our investment management. Okay, so we can be involved with markets when it makes sense and avoid being in them when it doesn't. All this stuff fits together. You know, Justin next month is going to be covering bucket planning through our true holistic process. All right, we found that it reduces worry. We know that it's not as simple as just plugging your financial plan into a computer and getting some type of output. There's real life things that are unique to you, and that's why we do our free initial consultations. It's why we do taxes, because they can be messy. We help you get organized. It's why we use Adaptiv, because it stands between you and uncertain markets. And then I want to end with, for our clients, we have a new investment portal coming out. It'll be a place where you can log on. It's going to be better reporting, better visuals, more functionality. It's going to be pretty great. Kevin's put a lot of work into it, so you can thank him when you see him. And then an announcement that Paul made after our live presentation that I want to highlight is we've opened up the Adaptiv system for the use with endowments and foundations. We have a couple churches that we manage funds for now, and the Adaptiv system works great for that. So if you have a school, an alma mater, or some organization that you work with, a church or a charity where you have some type of foundation or funds that need to be managed, think of us. We're here to help. That's what we want to do. And then, give us some feedback. When people are here, they fill out this form for us, but you guys that are watching this on YouTube or watching this online, send me some feedback. Let me know what you think. And then next month, it's actually going to be the second Wednesday, November 14th. Justin's going to be presenting our true holistic planning process. It's a really important and really insightful way to go about financial planning using a horizon planning technique where we're looking through time, not necessarily just through asset allocation and those things. So don't be sure that you can call in. You can call us at 262-335-1700 to reserve your seat, or maybe you've got questions, or you can email us at myteam@clientfirsttaxandwealth.com. So that concludes our presentation for today. I hope that you found it insightful. As I said, feel free to give me an email if you got questions about anything, or you want to come in and you want to check out more about the Adaptiv System. We can do that. It takes about 20 minutes, gives us some one-on-one time. But I did want to make you guys aware of that significant market development, as well as let you know that there are some concerns. Caution is the way we should be approaching the market currently. So thanks for watching this video.